Hey, this is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. You are tuned in to Next Level Charting. Remember, you can watch every Thursday at noon Eastern Time on StockCharts TV, or you can watch it on demand on our YouTube channel. And if you like this video, please give us a thumbs up. So today we're going to go over moving averages, the lag factor, EMA versus SMA, and direction versus cross. So let's start off with a weekly chart for the S&P 500, and this is what I use to get my broad market assessment. You know, sure, small caps are interesting, but it's the S&P 500 that is the main driver of the stock market. It is by far the most widely followed benchmark in the U.S., perhaps the world. It is also, it accounts for 80% of the total U.S. investable equity market, and most big funds are benchmarked to the performance of the S&P 500. So why I follow the S&P 500 is because when the S&P 500 turns, you're definitely in a bear market environment, and that's when cash is king, the sidelines is king, and it's a good time to, say, sharpen the saw and study up on some strategies and techniques to prepare for when we come out of the bear market. And I don't know when that will be. Nobody does. The best I can do is identify a change and follow that change until I get a signal that suggests otherwise. Now, if we look back, just using these simple moving averages, I've got the 40-week moving average in red, the 10-week moving average in green. That's equivalent to the 50-day and the 200-day equivalent, not exactly the same. These are simple moving averages again. And the thing about moving averages is they lag. So you can see that we didn't get a cross here, the 10 moving above the 40, until well after the market bottomed there in 2016. And then we moved sharply higher, long trend, and we got a cross here in November 2018 after the market had already fallen like 10% in that October. So that was kind of the confirmation cross. And then the other cross here in March 2019 was well after the bottom. And that's because moving averages lag. It's like a double-edged sword. If you're going to use two moving averages, you're going to have more lag. You're going to have fewer whipsaws, but you're going to be much later to the signals, so to speak. And you can see here in 2015, we also had a whipsaw 50-day moving, or so the 10-day, 10-week moving above the 40-week moving average and then right back down. But there are some things we can do to smooth things out. I've got the PPO here, and this PPO shows the difference between the close and the 40-week EMA. And you can see you're going to get a lot of crosses there. And you're going to get some fake crosses that don't happen elsewhere. You can see these whipsaws here. And if you just smooth it out with a 4-week moving average, exponential moving average, and use the PPO 440, you can see you can eliminate some of the whipsaws. And like I said, some of them. You're not going to completely eliminate whipsaws because whipsaws are going to happen. But you can see during this run in 2016, you didn't get any whipsaws there. And you can also see when it turned down in 2018, you didn't get these whipsaws like you had in the latter part of October and November. It stayed below. And if we look at the 440 EMA cross, we have a negative cross here. So this indicator has turned bearish. Now, this is still early in the week. We could rally back by the end of the week, but I have a feeling we're going to close below it. And that is a long-term trend reversal signal. It's one of. You know, there's 2 weekly closes below the 40-week simple moving average already. So I think that is a bearish signal. So here's a chart with the 200-day SMA in red and the 50-day SMA in green. And you can see that we didn't get that golden cross there until the beginning of April. And that was 1 to like 3 months after the market bottomed there. And we can see now that we're still well above. So if you're waiting for the death cross, you're going to get a much later signal. Now, what I've done here is I've got the PPO 1-200-0, which is the difference between the close and the 200-day EMA. And if you just smooth this out a little bit, with even just a 5-period EMA, you can reduce the whipsaws quite a bit. Now, you're not going to completely eliminate them. Like you can see, you did get just below 0 there in early June and here. But you can also see we got below 0 in August, but not if you used a 5-day EMA to smooth it out a little bit. But I think the important signal here is that the 5-day EMA has moved below the 200-day EMA because that PPO 5-200-0 turned negative. And I think that is a longer term, that signals we're in a longer term downtrend. Now, I would just like to note that moving averages don't work the same for all ETFs and stocks. The 200-day works really good for the S&P 500 and SPY, but it doesn't work very good for the Russell 2000 and IWM, as we can see here. So I've got a 550 PPO, 5-day EMA crossing above and below the 50-day EMA, and then the 5-day EMA crossing above and below the 200-day EMA. And yeah, sure, there were some trends here at the end of 2018, and then you got bearish in October and stayed bearish until February. But then it's just a series of whipsaws for several months. And we finally got a trend going here, but then we got another sharp decline, and that put it below. You can see the cross was way up here when you had, well, this is the EMA, the cross here in October. So you would have been getting in there in the middle of October around, say, 155, and you would have been getting out down here around 148 or something. That would have been an ugly whipsaw. But this moving average, the 200-day doesn't work that great for the Russell 2000 is basically the bottom line. And forget using these moving averages for support and resistance. I mean, sure, you can find instances when they worked, but I think you can find more instances. For instance, here's the 50-day acting as resistance and the 200-day acting as resistance. But then you got above it. Well, that breakout didn't hold. And then you got below it. Well, that breakdown didn't hold because you went right back above it. And moving averages only work in a trending environment. So you need a sustainable trend for a moving average crossover system to work. But I think when it comes to the 50-day and the 200-day or the 4-week and the 40-week moving average pairs, S&P 500 works the best of the major indexes. And just to let you know, on the StockCharts TV page, you can take part in our poll. This week's poll is, will oil trade above $60 again in 2020? And you can mark your vote there, yes or no. And you can also click on and watch the latest show on StockCharts TV while you're there. All right, so now I'm going to move over to Amy Broker because I want to show you the difference between an EMA and an SMA. And I've got the S&P 500 SPDR here with the 50-day EMA in green and the 200-day SMA in red. And you can see that the EMA green has turned down sharply over the last 3 weeks. And the SMA, a couple days later, turned down as well, but that downturn has not been as sharp. And that's the biggest difference. The EMA is weighting those more recent prices heavier than the past prices. So you got 50 days in the calculation of an EMA. Well, the first 25 days are going to be weighted less than the most recent 25 days. And so this period here is getting more weight than this period back, say, in January and early February. And that's why the 50-day EMA is turned down so sharply. Now, to quantify that, in the indicator window, I've got the 5-day rate of change for the 50-day EMA in the top window and the 5-day rate of change for the 50-day SMA. I just created these indicators here, and we can see that the EMA was rising from middle of October all the way until the latter part of February. And then the EMA turned down there at the end of February. And look how sharply it turned down. That downturn is greater than 1% there. And then you can see the SMA, because it lags a little bit, turned down a little bit later, a few days later than the EMA there. So this is the rate of change of the 50-day SMA. And if you look back at the previous signals, you can see here that in August, the 50-day EMA turned down, but the SMA was still rising. And then the SMA turned down there at the end of August. Now, as I said, just because you're using a moving average that reacts quicker doesn't mean you're always going to get better signals. Sometimes the EMA works better, sometimes the SMA works better, and that includes when they turn up and when they turn down, as well as the crossover signals. So now I've changed to the 200-day moving averages. So we've got the 200-day EMA in green there and the 200-day SMA in red. And you can see the 200-day EMA is turned down, and we can quantify that with the indicator there. That's the 5-day rate of change of the 200-day EMA. And you can see it turned down. The rate of change was negative on March 1st there, the first trading day of March, whereas the 200-day SMA is still rising here, but you can see that rise is less steep, but is yet to actually turn down. But I think that downturn in the 200-day EMA is another negative sign for the stock market. Now, just because you're using the upturns and downturns for signals in your moving averages doesn't mean you're going to eliminate whipsaws. You're still going to get them. They're still going to work just like moving averages. And I also like to point out that you can get battle zones around the 200-day EMA and SMA. If you look here, the S&P 500 SPDR broke those moving averages. It kind of battled around them and then moved lower. Well, it could rally back up to that 300 area and battle those 200 days again. You can see that happen here in October and November, actually November, where we broke through and then moved back above, consolidated, and then had another leg lower. Now, I'm not making any predictions here because predictions are very dangerous. At some point, we're going to get a rip-roaring counter-trend bounce, and the first level to watch would be that 300, low 300 area for potential resistance level. But if we look at the changes in the moving averages, this is the 5-day rate of change for the EMA. You can see it turn negative, positive, and then negative. And the 5-day rate of change for the 200-day turned negative, the SMA, positive, and negative. So you're still going to get whipsaws even when looking at the rate of change for these moving averages. But I think, you have to look at the bulk of the evidence, the weight of the evidence when it comes to the broader market assessments. And right now, we're below both of these moving averages, and one of them has turned down. So that means 3 out of these 4 signals, if you will, are clearly negative. And that is enough to be bearish on stocks. So that concludes this edition of Next Level Charting. Remember, every Thursday at noon Eastern Time on StockCharts TV. You can also watch on demand on YouTube. And of course, if you like this video, please give us a thumbs up. Thanks very much for tuning in and have a great day.